15 of 21 series are aligned with expansion strong this morning. That is a mathematically broad but not unanimous agreement across the framework's inputs. The current macro regime is expansion strong, with a confirmation score of 15 out of 21. In this macro regime, the framework is observing growth momentum accelerating at plus 0.09, in its composite and inflation momentum decelerating at minus 0.01. Mathematically, that means the basket of real economy indicators, including things like business surveys, spending, and production proxies, is trending higher on a rate of change basis, while the price pressure basket has been easing modestly. The coherence score is strong, and the confirmation score of 15 out of 21 has historically persisted in roughly 61% of comparable cases over 3-month windows when the regime was classified as expansionary. Compared to last week, confirmation has held in the same moderate band, while growth momentum has firmed and inflation has softened slightly, nudging the composite deeper into the expansion with disinflation quadrant. Historically, environments like this have felt like firm underlying demand with relatively calm credit and volatility, a description of past price behavior under similar readings, not a statement about what will happen next. Take Treasury yields first. The 10-year Treasury yield is around 4.63%, with the curve between the 2-year and 10-year sitting at a positive 0.45 percentage points. In the framework, that combination of rising long yields and a modestly positive spread is mapped as green, favorable momentum, because it reflects higher growth and term premia without an aggressively inverted curve. Quantitatively, the engine defines green as a sustained positive rate of change over its look-back window, with supportive structure across the 4 layers. In our framework's reading of comparable periods, this roughly coincided with contained credit stress and ongoing issuance within a few months, an observation under our methodology, not a forecast. The question market participants ask in this backdrop is whether higher yields change how much duration or equity risk they are comfortable carrying, and what would challenge the read is a sharp reversal lower in yields driven by growth disappointment. On the labor side, non-farm payrolls, the broad measure of hiring, is the signal the engine flags as red or unfavorable momentum in this morning's summary. That red tag on payrolls by construction means the rate of change in employment has cooled enough that the labor series is dragging rather than confirming the expansion composite. In plain terms, hiring has slowed relative to earlier months. Markets watch this because jobs data shapes views of household income, spending, and credit risk. In our framework's reading of comparable periods, this roughly coincided with pockets of underperformance in the most labor-sensitive cyclical groups within a few months, a record of past behavior, not a forecast. The question it raises is whether a softer hiring backdrop challenges the current pricing of cyclical assets. And what would challenge this read is a renewed acceleration in payroll growth. Credit conditions form the third signal. The framework's composite of credit spreads, including high-yield corporate spreads as a proxy for perceived default risk, is currently mapped as green, meaning spreads are relatively contained and the rate of change has been stable or narrowing. Markets watch credit because it often shows stress before equities do. In our framework's reading of comparable periods, this roughly coincided with steady corporate funding and limited forced deleveraging over several weeks. Again, an observation under our methodology, not a forecast. The question investors ask themselves here is whether benign credit supports their existing positioning, and what would challenge it is a meaningful, sustained widening in spreads. For a fourth signal, look at equity sectors. Technology is modestly lower in futures, while healthcare, materials, and gold-related exposures are higher, and the framework's sector rotation lens marks leadership tilting away from pure growth and toward defensives and hard assets. This mix is characterized as yellow, neutral, when leadership is rotational rather than concentrated, meaning no single sector set dominates the 4-layer read. In our framework's reading of comparable periods, this roughly coincided with choppy but trendable tapes, where relative performance mattered more than index direction within a few months, a record, not a forecast. The question it raises is whether sector balance changes how investors think about concentration risk, and what would challenge it is a decisive, persistent turn back into a narrow set of mega-cap growth names. 2 conditional triggers sit on the map today. If the 10-year Treasury yield crosses 4.45% and holds for 5 consecutive sessions, in our frameworks reading, inflation composites historically showed acceleration in roughly 9 of 11 comparable conditions, a historical characterization, not a forecast. In that backdrop, the regime classification has often moved toward an expansion to acceleration label in past data, a note of how the math has behaved, not of what it will do. If the popular Fear and Greed Sentiment Index drops below 15 and holds for 5 consecutive sessions, in our frameworks reading, the confirmation score deteriorated in roughly 7 of 9 similar episodes. Again, a characterization of historical behavior, not a forecast. Under those conditions, the engine has often marked regime confidence lower and raised a regime watch flag in prior samples. The map is live. These conditions are being monitored daily across all 21 series. The Given engine is the automated rules-based engine inside Given Analytics. It does 2 things in parallel. First, it publishes a view of the macro environment, the regime, the confirmation score, and the historical base rates we just covered. Second, it runs a fixed 4-layer mathematical framework: price structure, rate of change, risk regime, and market participation, across 407 liquid symbols every trading day. When all 4 layers agree on a symbol, the engine records it as an upside-aligned or downside-aligned condition under the framework, a reading of how the 4 layers line up, not a trade. These are time-stamped model readings, logged for members to study. The environment view and the condition log sit side by side inside the engine. They are separate outputs. The regime does not pick the symbols, the 4 layers do. Members use the engine to study how the framework has recorded conditions across prior environments, as historical behavior, not as trade selection. The Given engine runs the framework. You study the outputs and environment. You decide what to do next. All of this is framed as potential, educational, observations to learn from, not instructions. Every trading day, this is free. Watch real symbols go active in live markets at the price it's happening. See which sectors are leading and learn to read what's driving it yourself. That live view is the observation desk. The same 21 series and 407 symbols founding members study each morning. The environment underneath every move. If you want to watch it alongside us, the live view is at givenanalytics.com. Free to try, no credit card, for the first 500 founding members. Watch it before you risk $1, you decide.